Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello everyone, welcome back to another episode of Blind Spots. Today we are talking all about strategies to help mitigate estate taxes. So we're going to try to keep this high level, simple. We get a lot of questions about what happens to my money and my assets when I die. Is there any taxes? Is there any cost to that? So we are going to cover that today and how you can lower those taxes after you go away.
Right, so this is often called the death tax. And this is helpful for me because my neighborhood is on the investment side. So a lot of this prep, I'm peppering Aaron with questions, and it's a learning experience for me. So hopefully you all can get something out of this too. Aaron, why don't you talk about the two different types of estate tax at the federal level and then the state in which you live?
Okay, so we'll just refer to it as death tax or estate tax. So the first one is potentially at the state level, depending on where you live. There's only a handful of states that have a quote-unquote death tax. So we can provide the link to the map that shows, based on where you live, how much potentially that tax will be, if at all. And then there is a federal estate or death tax as well, based on different thresholds. So we'll give some examples. So in Oregon is known as one of the worst places to die because of our estate tax here. And it's because the threshold is 1 million. So if your assets surpass $1 million, you potentially will have to pay some estate taxes after you die. Typically, people will hit the state death tax before paying a federal death tax as well. The federal threshold is much larger than most states. So in 2024, the potential estate tax exclusion, if your assets are over and above this, you potentially have taxes to pay, is about 13.6 million. So many Americans do not have an estate over that, I'll call it 13.5 million. So you would not have to worry about the federal thresholds. Oregon, for example, is much lower. Many people do have an estate over $1 million.
So when you say estate, what does that include?
All of your assets. If you looked at your balance sheet, total it up, that's roughly what your estate is going to include. There's deductions and things that get taken off when it's all tallied at the end. But if you're getting close to any of those thresholds, that's when it's time to start having a conversation.
So not to get too deep in the weeds, but I want to be clear. So let's say someone is married and the husband dies or one of the spouses die, okay? That wouldn't trigger an estate tax. The money would flow to the other spouse.
That's correct.
If, God forbid, the second spouse dies, then that would trigger a potential death tax or estate tax, right?
That's exactly correct. So with the Tax Cuts and Jobs Act, that is set to sunset at the end of 2025, meaning it goes away. Any rules or thresholds that was set within this are potentially expiring. So the estate tax right now is, again, that $13.6 million threshold that could revert back to what it was previously. So it will get adjusted for inflation, but it's somewhere estimated in the realm of 5 to 6 or 7 million. So it's quite a big jump, call it being cut in half from where it is now to where it could potentially be if that's not renewed in 26.
And given the fiscal situation of this country, it probably is going to go down. And then what is the rate on that federal estate tax above whatever the threshold is going to be?
They ramp up pretty quickly in comparison to, let's say, what everyone's familiar with, your traditional federal income taxes. So over and above that 13.6 million, $0 to $10,000 is taxed at 18%. So $10,000 over 13 million is a lot. I'll just kind of rattle these off. 10 to 20,000 over and above that threshold is 20%, and then it ramps up every 20,000 after that for a while. Then it's 22, 24, 26, 28, up to 100,000. Then it starts going in $50,000 chunks from 100 to 150 is 30%, 32, 37. Once you're over $1 million over that threshold, it's 40%.
Wow.
So it really ramps up. After that 13 million, let's say you have a $20 million estate, and the math doesn't exactly work out like this, but just to put it into perspective, let's say you've got $20 million. You take 13,600 off of that, you're left with 6.4 left over. And again, not perfect math, but let's just take 40% just right off the top. That's almost a $2.6 million tax bill that you would have to write and have to have the liquidity for as well if someone dies with that level of wealth. So it ramps up really quickly. The tax bill can be high. So that's why it's important to talk about mitigating those taxes, because with anything, whether you're living or dead, it's not about what you make, it's about what you keep. So when the estate tax comes in, if you're thinking about passing that to heirs, to charities, that could be quite a chunk off the top.
Yeah, and that's less, I mean, the more you're paying in taxes, the less purpose for charity or money that going to your heirs. So that's a big deal. But back to your first comment, I think for most Americans, they're not close to that threshold. Now, it could go down, and that would change the conversation. However, I feel like most of our clients are in the neighborhood of their state death tax. So let's talk about, we talked about an unfriendly state to die in of Oregon, and you can make the case for Washington too. What are some estate tax friendly states, meaning they don't have a death tax? And then we'll get into some ways you can mitigate state death tax.
Yeah, so Oregon, Washington, even Rhode Island are notoriously low, between 1 and 2 million each. Some of the states with a higher threshold. Connecticut is the largest that still has an estate tax. Their threshold is just under 13 million, so pretty close to the federal limit. Their estate tax rate, I believe, is just flat at 12%, but some kind of in the middle in that $4 to $5 million range is Hawaii, Illinois, Maine, Maryland, New York, Vermont.
So I don't want to steal your thunder, but it could make sense if you have a large estate to get out of some of these states with the lower thresholds, meaning your estate doesn't have to be that big before you trigger estate taxes. So Washington, Oregon, and Rhode Island, would it be fair to say those are the worst states to die in from an estate tax standpoint?
Yeah, those are some of the worst states to die in. I can't remember who it was, big singer, maybe Prince, but one of them died in a very unfavorable state, and so their estate went through huge probate hearing and trying to get it changed and things like that, but they were subject to a pretty big bill just because of where they died.
Yeah, and this goes back to something that we talk about a lot, is a lot of retirees and investors focus on external factors, like what the Fed's going to do with rates and what inflation is doing, what the market's doing. It's like these are low-hanging fruit things that we can control to help potentially save someone hundreds of thousands or even millions on their taxes. So again, it often makes sense to turn the lens inward and focus on what we can control. And we're going to get into some things that a person with a large estate can do to help mitigate a potential death tax.
So yeah, that's the first one on our list to help mitigate estate taxes, is moving to a more tax favorable state if you don't already live in one. I don't discount the work or effort that it takes to move. It's a huge decision to move, different states, especially if you're aging or there's other factors, family. But if it's really important to you to not give a lot of your estate away to taxes, it's a potential consideration.
I like the state of Oregon. I think Ben's great. We have a decent amount of clients that live there, a decent amount of clients that live in Washington. But when you zoom out and look at things objectively, we're seeing a lot of people move to Idaho and Montana too. And it's because, one, is a lower cost of living, more favorable taxes, but also lack of a death tax. So I think folks are starting to wake up to this. But again, family, lifestyle, access to airports and hospitals. There's so many different factors that go into this. But if you're, again, hypersensitive about taxes and want to maximize what you pass on, moving to a different state could be a layup.
All right. The next one, before you even get to the point of dying, there's, of course, things that you can do prior to that to just lower your entire estate that's available when you pass too. So one of the most popular ones is gifting. So that's just straight money, cash out the door. So we'll touch on charitable giving specifically in a second, but let's just talk about regular old gifts to family and friends first.
Okay, so let's say Sherman's family, Nick and Rachel Shermans, that's my wife's name. We have 3 kids.
Yep.
Let's say when I'm older, and I want to start gifting money to reduce my taxable estate, what would that look like on an annual basis for me and my wife?
This is a very confusing topic, but it's not super complex. So we'll try to explain it as easily as possible. Let's see if I can. I have a great visual, but I'll see if I can verbalize it too. So I'll call it two different buckets. There's an annual bucket and there is a lifetime bucket. So each year there is an annual threshold of an amount that you can gift to any individual. So in 2024, that annual gift tax exclusion is $18,000. So as an individual, I can give anybody $18,000 each. I'm not limited to $18,000 in gifts total for the year, but I can, as a single person, I can gift $18,000 each. So in your example, you could gift each of your 3 children $18,000 each.
And then my wife could do the same thing.
Your wife can also gift $18,000 each. So each child would receive $36,000, but it's coming from 2 separate people.
And given that I'm within the annual giving limit, I would not have to file that as a gift tax return. Is that the proper way to say it?
Yeah, that's exactly right. So that's where that first bucket comes in. So that $18,000 that you gave to child number 1 fills up that annual bucket. And let's say each person gets an
Their
annual
own bucket. Yeah, right.
Everyone gets their own bucket. So that annual bucket gets filled up. Now at the end of the year, you're feeling really generous. You give them another $2,000. So $20,000 for the year. That's $2,000 above your annual limit. So the bucket's filled up. You get that extra $2,000. Now it's spilling over into your lifetime bucket. Your lifetime bucket, much larger. So that $2,000 right now is really, pun intended, drop in the bucket. So $2,000 spills over into the lifetime bucket, and that lifetime bucket is the same as the estate tax exclusion, so $13.6 million. Either way, it's not a taxable event.
So I'm not paying taxes if I'm giving a little bit more because it is within my lifetime exemption, gifting exemption.
Mm-hmm.
But for most people, I think sticking to that $18,000 a year is a good rule of thumb, right?
Mm-hmm.
And then let's talk about my example. So let's say daughter 1, daughter 2, son 1, they each get $36,000 for me and my wife. Is that taxable to them?
It is not taxable to them. They can get as much gifts from as many people as they want, and they do not pay any taxes.
Okay, a few more things. I think you really liked your own joke there. You were trying not to laugh, and you really like to talk about buckets.
It's a great visual. I am really proud. I give myself a pat on the back for coming up with that.
Aaron likes this bucket thing so much. She's going to do a video, which it is a cool visual, that's going to show this because most people, myself included, am a visual learner, and I have a tough time tracking complex topics when someone's just talking.
Just rattling off numbers, it gets confusing. So where your gifts can become taxable is when your lifetime bucket fills up and spills over. That's anything above that lifetime exclusion then becomes taxable.
But that lifetime exclusion is like 13 million, right?
Exactly. It's pretty large. So again, most people aren't gifting in excess of 13 million in their lifetime.
So I also think it's a fine line, right? Like you want to be below the estate tax limit. Like if I'm thinking about my kids, a gift to my kids would be much more meaningful when they're 24, just got married and looking to buy a house, as opposed to being 55 and they've made a bunch of money. So it's a delicate balance between maximizing the gift for their best use, maintaining my current lifestyle and making sure that I have more than enough, and then being mindful of that is the state, because that's really what we're talking about, the state estate tax limit. Estate tax limit. That's kind of clumsy to say.
So a lot of people overthink it. If you want to give a gift, give the gift. If that means that you have to file a gift tax return, just file it. It's not a big deal.
Okay, that's good. That's good because we're getting, I mean, the demographic in this country is getting older. A lot of our clients are retired or about to retire. They're getting older, and this is coming up. So this is a timely topic.
Yeah. Okay. Last but not least, we will talk about charitable contributions. This is another popular way to lower the value of your estate so that you can help hopefully avoid some estate taxes when you pass. So We'll just talk about one basic one, and this is qualified charitable distributions, also known as QCDs. So this is a contribution that comes directly out of a pre-tax account like a traditional IRA, a 401, and it goes directly to a qualified charity. You can start these before your required minimum distributions start. So you can start them at 70.5, and you can distribute and contribute to a charity up to $100,000 a year tax-free. So normally any money that comes out of the traditional IRA, 401k, any pre-tax account is going to be taxable to you. If it comes out, goes directly to the charity, not taxable income.
And so in practice, we have several clients that are starting to do this, and they actually take their RMD. So feds require you to take out of an IRA each year, which again would normally be taxable, and they're sending it straight to a charity. And what's nice about this is you can send it to multiple charities. It doesn't have to all go to one. So we have a client that's based up in Seattle that sends it to 4 or 5 different ones, and it's really cool. He feels good about it. There's purpose behind it. He has a great time tracking the benefit of the money that he transfers to the charity. So it's a really cool way to stay active, to stay involved, and feel good about not only mitigating your taxes but doing well in the community, whatever you're passionate about.
Yeah, it's really popular. Of course, it's a great tax mitigation strategy while you're alive too, because if you didn't go the route of sending it directly to the charity, you would be taking that money in, paying income taxes on it, and then just writing a check to them from your personal account, let's say. This way you avoid that income tax as well. So it's a great strategy.
All right, so recapping, moving to a friendly state without a low estate tax threshold. 2 is
gifting money, sending it out
to whoever you want, kids. Okay, so can I gift to a friend?
You absolutely can. You can gift to me if you'd like.
So it doesn't, that's weird. So it doesn't have to be a family member or a child or an uncle or an aunt. It could be the guy. So, okay, cool. All right, and the third one is charitable giving. And we talked about just one example. There's a few others, but we don't want to get deep in the weeds. If you want to talk to one of our planners about how you can give out of your IRA, give out of your taxable account, which is a little bit different, feel free to reach out to us. And again, this is becoming a regular conversation in our planning meetings.
Yeah. So those are all different strategies to help mitigate estate taxes. So if you have questions, you can send them to insight@pureportfolios.com. We will see you in the next one.